Hey everyone, this is Kirk here again at optionalpha.com. Thanks so much for checking out this video tutorial and kind of rounding out the week here. Had a really good day and making a couple very strategic, I think, positions in where oil is headed. So I want to go over those and then we'll get into some of the closing trades, but had a nice Friday to close out some very nice big profits in First Solar and Tesla with just some directional debit call spreads that we entered about 2 weeks ago or so. So to start off the video tonight, I want to go over XLE and OIH. Now both are really continuing this trend that I've had over the last couple of days of shorting oil at these high prices, right? So we have a position in CVX, in Chevron, and so we're going to continue to add kind of this short or bearish positioning in oil. And not to say that I definitely think oil is going to go down. I just absolutely think that it's gone too high too fast. And I think that we're in for some sort of a correction. So by doing that, by taking this kind of position in oil, that I think we are going to see a little bit of a correction, at least sometime in the July expiration month. I've also diversified the strategies that I'm using by trading both a put spread and a calendar put spread as well. So not only am I just diversifying in sectors and ETFs and all that, so Chevron and then the XLE and OIH, so I'm diversifying across different actual strike prices or trading symbols, but I'm also diversifying in the strategies, which I talk about a lot on the blog and have written posts about before over the number of years, is diversify not only in the actual underlyings, but also diversity in your strategy so that if one strategy makes money sooner or later than the other, you've got opportunities on both ends of the spectrum. So today, let's talk about XLE. So we went ahead and bought 3 vertical July 14, only meaning the 2014 monthly contracts for July. We went ahead and bought 3 of the 102 100 debit put spreads. And we paid about a penny under mid price for those, or 99 cents. So you'll notice that the width of the strikes is $2, and we like to pay about half that width, which is about $1. Now that puts our break-even price at about 101. So ideally, by expiration, we need XLE to trade at or under 101 for us to make money. So here is a chart of XLE today, and you can see exactly where it closed. It closed at 199, or I'm sorry, the high of the day was 199, but actually closed at 193. And you can just see, again, the reason that we're entering this trade is that we don't see some crazy technical indicator. We're not looking at that. Implied volatility is super, super low on these things, so it's gotten really out of control. It's very complacent, and you'll notice that it's just had a monstrous kind of exponential run up in the last month. So not to say that this can't continue to move higher, it absolutely could, but we're just saying, you know what, the odds of it moving higher at this rate are starting to dwindle, right? And we're going to start to see people start to take profits and hopefully get some sort of a correction. Now, our line in the sand, or where we make or lose money, is right here at 101. So that's really our point at which we say, you know what, we make money or lose money at expiration. All we're looking for is that at some time between now and July expiration, which is right here, we get a move down in the security, which is below this level. That's all we're looking for, making a directional trade. So again, if you want to take the other side of this trade, go ahead and take the other side of this trade. We're just trying to make a directional trade on oil going lower. If we actually go to the underlying here, and you guys can see where our current position is in XLE for June or July expiration. Let me just scroll all the way down. You'll notice that we're kind of straddling the market here with our strikes. So our 100 strike is right here, and then we go over the 101, and our 102 strike is right here. So that gives us the difference between these two as a price point of about 99 cents. That's what we're looking for. And our break even is very, very close to the current market price of XLE, which is ideally what we want. We don't want to break even too much further lower or too much further higher, and have basically a 50-50 shot on either side. All right, so the next trade that we went into for oil, just kind of doing this whole short in oil right now, is a calendar spread for OIH, which is another ETF for oil. And we went ahead and did the August long 655 put and sold short the front month option, which is the July 55 put. Now this is a little bit different because we are actually trading a weekly contract for July, and that's just because it is the weekly contract for July, but we're doing this because there are no other July monthly contracts. So that's the reason we went ahead and did the July weekly. And I'll show you guys here in a second what I mean. But typically we like to do the front month option and the back monthly option. So in this case, it would have been the July monthly and the August monthly. Well, OIH doesn't actually have an August monthly contract. It only has an August weekly and just one of them right now. So we went ahead and entered that position. So with this put calendar spread, we are long the August at 55. So we're long this, or give it a plus symbol. We're long the August option, and we are short the July contract at 55 for the same strike. Okay, so we're shorting the front month and we're long the back month, and that gives us our calendar spread. That's just a little bit out of the money because, again, we'd like to see the stock kind of move a little bit before we actually make some money. We're definitely short and bearish OIH. All right, so you see here's a look at OIH, very similar type setup, right? So this is why we're diversifying across all of these. Massive, massive move north in the actual ETF. And implied volatility is for all intents and purposes at 0, meaning it's basically at the lowest point it's been in the last year or so. So this gives us a great opportunity to sell premium and buy back month option volatility. So if we get a drop in oil or even a move up in implied volatility, we could see a nice little profit in this trade. If we actually go to the trade tab here of oil so you guys can take a look at this, where our strikes are located, you'll notice what I said before. Let me just collapse these down to about 8 or so strikes. Perfect. So I have both the July options open here. So the July, which are 28 days away. And you'll notice that there's a July weekly and an August weekly, which is here, which is what we're trading. So we're trading that August weekly, but there's no other August contract. So the next contract month is out to October. And that's really too far out, right? We don't want to trade something long about 119 days out. So this August contract gave us a nice little window of opportunity. It's got about 42 days to go before expiration. So that gives us a nice spread between our current market short contract at the July 55 and our long at the August weekly contract at 55. So it's not to say you can't trade weeklies. Sometimes people get weeklies confused and they always think that the weeklies are the most recent contracts that are expiring next week. That's not always the case. We can do July or August or even June weeklies. There's still a lot of June and July, August weekly options that are still available. But in this case, there was no monthly contract out for August, so we went ahead and traded the August weekly. All right, here's a look at what our risk profile is going to look like for this OIH trade. It's a very basic calendar spread that you've come to know before, right? It's got this huge, huge peak. So it peaks right at our strike prices, which is 55, and then has nice slope on either side. Now you'll notice we actually place this just a little bit further from the market current price right now. So sometimes we like to move a little bit closer and make this calendar already in the money, meaning our break-even price is above where the current market price is. But in this case, we do need a little bit of a move down in OIH to start making money at expiration, and that's okay. That means our spread was a little bit cheaper. And so we have a nice window of opportunity from, let's call it, a little bit above 56 to just a little bit below 56. So about 56 to 54, I'm sorry, a little bit below 54. So a nice window of opportunity to make some money between about 54 and 56. Now if we go back to the chart here of OIH, that means that we ideally want OIH to trade right about in this range between now and expiration. So a pretty good window of opportunity and absolutely doable, right? It's definitely broken outside of that range today, meaning that's where we enter the position. We know that. So we've kind of made our range or our profit potential right inside this range here by July expiration. So we need to move down in the stock and we need it to kind of settle into this range, and hoping that after this huge move higher that we're going to get a little bit of a sell-off and the stock is going to slowly drift downward into this range by expiration. So that's the ideal situation. A little bit different setup than XLE and CVX, which we did the other day, but still very, very short the oil sector right now. All right, so two of the trades that we closed out today and had some very nice profits on are FSLR and Tesla. Now, both of these were debit call spreads that we had originally entered, and so we sold both of these back to the market for a credit. Very nice credits in both of these. FSLR, we sold back to the market our 62.5, 65 debit call spread. We sold that back for a $350 credit, so we made $90 on each of those, so a nice $180 profit. And then on Tesla, we had a nice jump in Tesla and sold that back to the market. It was our 210, 215 call spread. Sold that back to the market for 375 in credit, so we made about $110 on that trade. Again, very, very good trades on both of these. All we got is a move in the direction that we were hoping for. So with First Solar, we were long the stock and made a directional move. We got the directional move. Implied volatility basically didn't go anywhere, but the directional move is really what changed this thing and gave us a nice quick profit. Same thing with Tesla. We got the directional move in Tesla that we were anticipating, and again, we just kind of actually picked it at the right day where it continued to move higher right after we entered the spread in the morning. So we've only been in this trade for a couple days and we made about $110, which is really, really good for our use of capital, right? We've only been in this trade, I think, 4 or 5 days, and our use of capital is extremely low because of how much money we've generated risking so little money for 4 or 5 days. So great return on our investment. Very happy with those. And really, that's all you need to do with some of these debit spreads in this low volatility environment. Some of these are going to hit, some of these are going to be losers. But when you have a nice winner like First Solar and Tesla, you got to take the trade off and kind of run with it, right? And now recycle that funds or those funds back into your portfolio for other trades. So as always, hope you guys enjoy these videos. If you have any comments or questions about the trades that we entered here today, please add them right below into the comment section. If you're watching this video on YouTube or somewhere else publicly online, you just have to understand that these trading alerts and this video only go out to our members the same day. You're actually watching this video online or publicly at YouTube about 10 to 15 days after this video and alerts have gone out to our members. So if you're interested in getting some of these alerts and finding out more about how to trade options the smart way, please check us out at optionalpha.com. Other than that, happy trading.